Yeah, today I'm just going to do a video regarding paying cash to buy an investment property versus leveraging on taking a mortgage loan. That is, if you have cash, in this case, if you have cash up to 500,000 and you want to invest in investment property um, versus you using the same 500,000 to buy multiple properties. We want to see which one, using examples, actually bring more returns on your investment. And in this case, we have assumptions. For example, one of the assumptions is that we are going to be buying a duplex. A duplex means two legal family dwellings where you can rent out to two families legally. And the other assumption B, is that we are investing 500,000 cash, and C, you are also going to be managing the property or the properties yourself. Um, the closing cost is not included when investing with cash. That is, one of the scenarios is to invest your money with cash down a property of 500,000, and you are not owing anything. You don't need to pay the mortgage. So in such a case, we are not taking into consideration the closing cost. However, when you invest in multiple properties, you are going to pay cash. You are going to put money down for the closing cost. The closing cost in Canada, the bank sometimes want to see up to 2%, but most banks is between 1.6 to 1.8%. And the term of investment is 5 years. That is, you want to buy the property for a minimum of 5 years before you decide to sell them. And we're also going to assume there's no vacancy. That is, once you rent the property, the tenant are going to be there. There's not going to be vacancy, and even if they move out, as they are moving out, another tenant are coming in for the period of 5 years. We are going to take into consideration these very important factors. Number one, regarding the return on investment. Number one is appreciation. Number two is mortgage principal pay down, and number three is the cash flow. That is, appreciation is the what accumulate year in year out to your property in terms of increase in value from year to year. And the mortgage principal pay down is how much you are able to pay down out of the mortgage loan that you take. In the case of when you buy the property with cash down, you don't need to pay any mortgage. And we're also going to look at the cash flow. The cash flow is when you have paid all expenses, the mortgage, insurance, the property tax, the maintenance. What is left behind? What is left behind is the cash flow. So we are going to see the cash flow. These are the things we are going to use to measure the return on investment. The reason why I'm doing this video today is because of few immigrants are able to come up with a lump sum of money, and they don't know where to invest. They don't know what to do with it. Or some people make the money in here in Canada. They are looking for a way to invest the money. They don't know what to do with it. And the fact that most immigrants from Asia, from Africa, have this orientation from the back of their mind that they don't want to owe anybody any money. Unfortunately, Canada is not a cash economy. It is a credit economy. And the more we're able to learn this, the better. And the more we're able to leverage on the advantage, the better for our family, the better for us. So, situation one, buy one property, 500,000 duplexes, two unit family, just one. Cash. We don't have to spend any money. So the advantage of this is that you don't have to bother your head to pay the mortgage every month. However, don't forget you still need to pay insurance. You still need to pay property tax. And let's say the gross rent from this duplex is 3,500, 3,500, and you're still going to be paying for your insurance. For example, if you buy a house of 500,000 in Winnipeg here, the property tax is usually about 1%, 1 point something percent. So that is about 5,000. So you're still going to be paying that. And how much is that in a monthly? That is about 417, 416 that you are going to be paying every month. You're still going to pay for insurance. Insurance could be around maybe 250. Let's assume that the total cash flow every month for you when you buy your property cash is going to be around 2,700 per month. So every month you have invested 500,000, you are going to be getting 2,700 as a cash flow. So what is going to be the return on investment in 5 years? So the first thing we need to consider is that what is the appreciation rate. For example, in our appreciation rate in Winnipeg is between 3 to 6%. Some neighborhood appreciate by 3%, some 4%. I know where you can get most appreciation for your money. So I'm going to use 6% as appreciation rate. So the first year the property becomes how much? At the end of first year, the property that you use your cash to buy, we appreciate 30,000. That's 6%. So first year and the ending of first year, it becomes 530. Ending of second year, 561. Ending of third year, 595,000. Ending of fourth year, 631,000. Ending of fifth year, 669,000. That is, your property appreciate by 6% every year. Now, don't forget, one of the assumptions we made was that the property is going to be self-managed. I'm assuming you are managing this. So cash flow again, 2,700 every month, and cash flow in a year for that one property is going to be 32,000. So year in, year out, you are going to be getting 32,400. So in 5 years, the total appreciation is 169,000. I mean, your property becomes 169,000. No, the total appreciation, that is what is on top of 500,000, is 169,000 in 5 years. Principal mortgage paid down, because bought with cash, you don't need to pay anything down. So, and cash flow on this one property in 5 years is 162,000. So, on that 500,000 that you have invested in 5 years, you are going to be getting return on investment of 331,000. That is not bad, you know. However, let's look at when you want to leverage, take the mortgage loan, apply for the mortgage, and instead of buying one property, you want to buy 4. So instead of 1, you want to buy 4. 1, 2, 3, 4. You want to buy 4. So, however, when you want to buy 4, I'm assuming you are putting 20% down payment. So the property is 500,000 each, and 20% of 500,000 happen to be 100,000. So you are putting 100,000 each. So you are going to be taking mortgage of 400,000. I'm also assumed that you are going to be needing closing cost. Anyway, so each property is a duplex. So I'm assuming the mortgage rate here is 4.25. Some people will ask me, why am I using 4.25 at this time? Today is November 28th, 2023, And the reason, this is my reason. The current interest rate, we have not witnessed it in the last 20 years. So that is very uncommon. And this video is going to last for many years for an investor to reason upon. And so I'm assuming the interest rate, even though the interest rate is not going to go back to what we are used to, like 1-2%, but something in the neighborhood of 4 point something or 3 point something is may likely come back. In actual fact, in the last 2 months, the federal bank, Bank of Canada, has not increased the mortgage rate from 5%, and from all the indication, that may be the last for the year. And hopefully by next year, middle of next year, interest rate may likely start to come down. So if you take a mortgage of 400,000, so instead of one house, you bought 4 houses, 1, 2, 3, 4, and you take a mortgage of 400,000. So if you take an interest rate, the same, you are using the same 500,000, but in this case, you share it into 4 to be able to buy 4 houses, and you still have additional 20% and 20,000 on each of the house. So you use that one for closing. The closing cost, like I said again, between 1.6 to 1.8% of the value of the house that you're buying, and use the remaining balance from the 20%, 20,000 each of the house, to do a touch up, make the place look nicer, do a backlash in your kitchen, do some little painting and touch ups, for the new tenants to come in, and you rent the place each, the 2 units each to 2 families. So you're having how many families? 2 times 4, 8 families, because now you have 8 units instead of one house which has just 2 units. So, and again, you are self-managing the property. If you take a mortgage of 4.25%, your interest rate, your mortgage is just going to be $2,159 every month. And don't forget, your gross income that is coming from each of the house is $3,500. So the property tax is $5,000 per year, $417 per month. Maintenance, I'm going to be using 10% of 10% of the gross income for maintenance. That is $350. So you make a provision of $350 every month for maintenance. It's very important. Some people ask me, because I'm buying a new house, I don't need to put expenses for maintenance. That may be wrong. You need to make provision for maintenance, even if it's a new house. I mean, if you don't have the need to spend the money, good for you. However, you need to make a provision for it. And insurance for this kind of building, $250 per month. And when you look at all these expenses, the mortgage, the property tax, the maintenance, and the insurance, you have a cash flow of $324 per month. So in a year per house, in a year per house, you have a cash flow of $3,088. In the 4 properties per year, you have a cash flow of $15,552. And the cash flow for the 4 properties in the 5 years, you have $77,000 plus. Now, don't forget, the initial mortgage we took on the house was $400,000, and out of that $400,000 per each of the house, you pay them $12,054, based on the assumption that 50% of the total mortgage you are paying, some of the money goes towards your interest, and the other part goes towards the principal. So now, you're paying down 12,954 every year out of the money you owe the bank. And in 4 years, for the 4 properties, you pay down 51,816. In all the 5 properties, you pay down from your tenant, which tenant help you to pay down 259,000. So in the 50 years, at the end of the 50 years, the outstanding mortgage balance for each of the house is now 335,000. Don't forget, we started with a mortgage of 400,000. But at the end of the 5 years, you are now owing 335,000 per house. Now, let's look at the return on investment, and we are going to start with the appreciation. So, based on the appreciation of 6% in the neighborhood where we have invested our money, so the house has now risen in value from 500,000 to almost 670,000. And so you have the appreciation on each of the house for 169,000. Don't forget, this property was purchased for 500,000. Is now valued to be 670,000 approximately. Now, the appreciation is your own money, is the return on your investment. So multiply this amount of money by 4, because you have 4 of this. You have 4 of these properties. Don't forget. So you have, for appreciation alone, you have been able to have a return of 676,000 on your 500,000 that you have invested. Now, the principal mortgage paid down on each of the house in 5 years. On each of the house, pay down 64,000 plus. On the 4 houses, you paid down 259,000 in 5 years. The cash flow that comes from each of the house after you have paid all the expenses on the monthly, yearly, the total comes to 77,000. So when you add this and this and this together, for a total of 5 years, you get 1 million. So which means that on your 500,000 in 5 years, apart from the 500,000 principal, this is what you have. Now, on buying one property with your cash only, I don't want to owe anybody. This is what you get. So, the return on this is 3 times this. I'll give you an idea of what I'm trying to do here. A leverage of leveraging on loan, leveraging on the money available in the system, leveraging on the bank money, leveraging on other people's money in order to create wealth, instead of having to work for all your cash and depend your cash. If you leverage on the mortgage, you get there faster than leveraging on your own cash that you have labored for. You may have questions from this video. Let me know. You can send me a text. Call me. My number is 204-963-7811. My name is Akindele Opola. I'm a real estate investor and also a realtor in Winnipeg, Manitoba. Thank you. And if you have any contribution to this video, you are welcome. Thank you so much.